Hi, Mike Coe here. I am joining you from Winnemucca, Nevada. On the phone, actually, with me, Carter Worth, as usual, from New York City. CNBC is continuing to cover the Olympics through this weekend in Beijing. And so we are bringing you this Web Extra. Now, an interesting thing about Winnemucca, Nevada, this is part of the mining area in Nevada. In fact, 75% of the United States gold production comes from this area, and the two largest employers where I currently sit are Newmont Mining and Barrick Gold. Now, Carter and I have been speaking a lot about the metals and the miners lately. Today, we saw a lot of unusual options activity in XME. This is the metals and mining ETF, and an important distinction I would make between this and, say, GDX, the gold miners, things like that, is that this also happens to include some other companies like Peabody Energy, which is a coal company, Alcoa, and so on. Carter, what are you seeing in the charts for XME?
Well, that's right. This is an exciting part of the market in the sense that there are a lot of people who believe in the cyclical trade here, the beta trade, rate sensitive trade, if you will, and or value trade. But let's just look at the chart of this ETF. Here it is, and it has no judgments. Let's draw some lines. So now, what? That's one full year, March to March, where it's done absolutely nothing. But it's the precondition before the nothing that matters. Anything that goes from 15 to 45 and then spends a year resting and consolidating and then starts to reassert itself and move above ever so slightly the range it's been in, that's the definition of a breakout. Another way to draw the lines is like this. It doesn't matter what you call it, it's a good setup. One should be long.
Obviously, as we continue to concern ourselves with what's going on between Russia and Ukraine, it may be no surprise that another name that was seeing a lot of options activity today, Lockheed Martin, ticker symbol LMT. So, an important thing about Lockheed Martin to consider, for one thing, they do have one potential roadblock in front of them right now. They had a deal to merge with Aerojet, and it does seem like that is probably going to be in doubt at this point, and it seems unlikely that even if they take this into court, that is going to result. Now, uh, another thing that a lot of people look to companies like this as essentially a bolster for the stock is the fact that they have a big stock buyback program. Now, we could argue whether or not buybacks really benefit shareholders, whether cash on the balance sheet is necessarily better than the anti-dilutive effects of the buybacks. Nevertheless, this is something that a lot of people look to as a potential level of support, essentially. And finally, it does seem that a lot of the foreign buyers for the defense contractors are looking to essentially continue to update their equipment. And I think it's important to remember the defense contractors, about 25% of their revenues actually don't come from the United States. What are you seeing in the charts for Lockheed, Carter?
Well, the first thing that jumps out is the impressive relative strength. So think we know the market's under pressure, small cap, large cap, certain value stocks, many growth stocks, tech, QQQ. The stock is unchanged over the last 3, 4 weeks as the market is under severe pressure. So one way to draw the lines is like this. You can see in the chart here that we're toying with the prospects of breaking out above the highs from some 10 months ago. Another way to draw the lines, and this would be on the next chart, a longer term chart. This is the weekly bar chart with no judgments. And if one puts in the lines, it's clearly this, right? We've moved out of the apex, the formation, meaning the standoff is at an end. Bulls are in the ascendancy, and the implications are this is something to be long.
Very topical at this point, obviously, the conversation about rates. Now, this has been going on for some time, and when we talk about rates, we always talk about financials. And when we talk about financials, we usually talk about the big money center banks. I'm talking about Bank of America, JP Morgan, Wells Fargo, Citi. But an area that saw a lot of activity today, Bank of New York Mellon Corp. And the interesting thing about this one is that it is really quite inexpensive. It's trading a little less than 12 times earnings. I believe it's a little less than 1.2 times book value. This is a very attractive level typically for financials. Is it attractive from a technical perspective?
It really is. And this one, as they say, the lines draw themselves. So here's simply the chart over the past 2 years of BK. And what I've included is the automated trend line. That's all that a moving average is. It's an automated trend line. Now take a look at the next. That's the actual. Let's go back and forth. Automated, actual trend line. Automated trend line. The point of a moving average is to try to not to say make quick work, but instead of having to draw lines all night, all day, we can try to automate the process. This is the definition of stay long, be long. It's quite good. And then just one for fun. Look at the long-term chart. And this is interesting and it's telling. So you see there, it's peaked in the year 2000, as was the case for so many stocks. And at that point, BK earned $2 a share. Here it is this past year in 2021, it got back to that peak and it earned 414 a share with earnings estimates in Wall Street for 475 in 2022. Now, valuation is not a good timing tool. That is well known. But the principle is when you return to a former high, as far back as this, and you're, quote, cheaper, if you will, than you were then, what causes the breakout at some point is that it's just too cheap and it exceeds the former high. I think you play this for the breakout. The day-to-day chart is good. The long-term chart is interesting.
That is really interesting. Another name that certainly looks cheap on a valuation basis, although certainly for a lot of good reasons one could argue, is Altria, ticker symbol MO. We spoke about Philip Morris International not that long ago. This is a stock that looks like it's coming to life. And an interesting thing about it is that this is also an area relatively stable where options are fairly cheap. And if one is considering playing it for further upside, you could buy near at the money calls for only about $1.80. I was looking at the June 52 and a half. From your assessment, technically, does that make sense?
And it does. And actually, just before the Olympics started was one of our last trades together, doing, of course, PM. And so the thought was maybe we could look at Philip Morris. A couple of charts. Here's the day-to-day. First, relative strength. How many stocks are up over the past 2, 3, 4 weeks when the market is down over the past 2, 3, 4? Relative strength, very important. Now let's put in some lines. Toying with the prospects of moving above well-defined tops at a common level in effect for the better part of a year. Another way to draw the lines, you could call it this. Some people like to name their patterns, a cup and handle. It doesn't matter what you call it. Now, if we look at the next iteration, this is really what's fun. Obviously, a great winner, one of the greats of all time, that then this is from the 2009 low, that peaked as far back as 2017 and basically got cut in half and then some. But this action over the past 2, 3 years in the context of the 10-year chart is very developmental, and all indications point to higher prices.
One wonders, with all of the volatility that we've been seeing in the market, if somebody is saying smoke them if you got them. I think,
Yes.
Carter, we got a couple of tweets. What are we looking at here? Do you see a tweet for
I
us?
do. That's right. So this is Mike and Carter. Great content and well explained. When rolling options, when is it best to execute your roll? Up or down day for the position? High, low volatility? Is it even important if you're essentially continuing the same position just with a new option?
Well, here's the thing. So you didn't specify whether you're talking about rolling a long position or a short position. Here's an important thing to think about when you consider how options behave. They decay much more rapidly as expiration approaches. So what this means is you typically want to roll your long positions well before expiration, before you start to see that accelerated decay. On the other hand, if you are short options, oftentimes it makes sense to wait until the week of expiration before you make that adjustment. Now, I'm going to give this one little caveat, and that is that when options get extremely dollar cheap, so let's say you sold a call for $2 against stock that you own, and now it's trading a nickel. I don't think it's worth waiting until expiration to try to capture that last nickel. You can cover those and look to roll. But for the longer positions, you don't want to wait until expiration because you're going to lose all your premium. Do we have anything else?
I think we do. Uh, Carter and Mike enjoying the Olympic interlude broadcast with an exclamation point. Wondering what your general parameters are for setting trailing stops on debit spreads. I just lost some profits due to a good till cancel stops and crazy opening spreads. Thanks.
So I'm going to ask your opinion in a second about stops, but I will tell you I don't use good till cancel stops. I think there's a tremendous amount of risk because you can have big gaps on the open, and you want to be able to assess what's going on in the marketplace and not automatically have orders fire off. Also, when you see those gaps, you often will see wider bid ask spreads, and that might be particularly pronounced if you have multi legged spreads and options, and you might not get the best possible execution. Just thinking about stops, if I'm long premium and I've lost about 40% of it, that's usually an area where I might consider stopping myself out generally. But again, not with a good till cancel stop just sitting out there. And on the other side, typically, if I start seeing a short option get to 60 delta or greater, I will continue. I will consider covering it. But Carter, what are your thoughts about good till cancel stop orders?
Well, so in my view, good till cancel as a concept, which means you're kind of blind, right? And it's not up to you at that point, is really only to be sort of entered into in one of two circumstances: a stock that you like or want to own, but you can't quite come to grips to buy it at the current level, and you're having a good till cancel buy ticket so far below the market that if and as it were to get filled, you'd be happy to take the stock. And conversely, a good till sell can a good till cancel sell ticket, which is something that you own, that if it got so crazy price, you'd be willing to sell it there. But having good till cancel stops, no thanks.
Yeah, I'm with you there. Folks, we really appreciate your time and viewership over the course of these last couple of weeks. We will see whether we're going to continue something like this. I think we hope to. Appreciate it. Give us a like and send us your questions, and we will try to answer them either in another Web Extra or possibly on the regular show. Carter?
That's right. And we do hope to continue. But for now, if you'd like to get alerts when we do post videos, subscribe and hit the notification bell.